Hello and welcome to Money Control. Well, yesterday the US Federal Reserve raised rates by 25 basis points exactly on expected lines. 2 weeks ago, we were expecting a much bigger hike, but obviously the SVB fallout has moderated that, and the Fed pretty much raised rates on expected lines. Now we are just one stop away from the terminal rate, which is 5.1%, which is a 25 basis point hike from where we are right now. And one small nuance that came out of yesterday, the stance is now changed from ongoing increases to some additional policy firming. This is all wordplay by the Fed, and we are going to understand what this means and a lot more. I'm Mahalakshmi, and I have with me Devina Mehra, founder of and chairperson of First Global. Thank you, Devina, for joining me today for this discussion. What a pleasure to have you.
Thanks, Mahalakshmi, for having me. Always a pleasure to talk to you.
Sure. So, Devina, first your take. Everything on expected lines. What is your sense? What lies ahead? It looks like the worst part of the rate hike is over, but there might be other challenges going ahead. What's your take?
Okay, so now in terms of what I wrote in Money Control itself last week, I had said much. I had said that 20 come through. Now the thing is this. That while the market is expecting just one more hike and in fact cuts in the second half of the year, the Chairman Powell was very clear that that is not the Fed's base case. He said in so many words multiple times that as of now, the Fed is not factoring in any cuts this year, that as the base case. So what he said was that inflation will remain the target. So till that 2% is in sight, Fed is not going to step back. But now this is the fallout of the banking crisis. So as he had said that between the last meeting and this one, first they were planning to tighten even more because inflation had not slowed as much as they would have liked and the labor market remained extremely tight. So those were things which indicated that more tightening was required. Then the banking crisis kind of changed things. But what the banking crisis also has done is that credit is tightening. That there's a kind of financial tightening in the system. So which has a similar effect to what the Fed hike does in terms of impact on GDP growth, on inflation, on labor markets. So now what the Fed is watching is that how much will this credit tightening do their work in a sense. So if that achieves part of what they want to achieve, they may not do as many hikes. But clearly they are not taking the hikes off the table till it is clear that inflation has been taken. The message I got from the speech and the presser by the Fed.
Sure. Just, I want to understand the fallout of this SVB crisis and the real threat and risk to the system, Devina. We'll just spend a couple of minutes on this. So one data point that came up was that the unrealized losses in the banking system in the US is about $620 billion, and the balance sheet size is about $23 trillion. Now, obviously, the market is signaling that there are certain banks, US regional banks, which might be under threat because of a asset liability mismatch or a liquidity mismatch. Now, what kind of chance or probability do you attach to any blow-ups that happen over the course of next few weeks, if at all, will snowball into a contagion? Could you hear me?
Okay, I think I lost your audio for a bit, but
So I was
I
asking.
lost your audio for a bit, but I think I've got the gist of the question. Now, I have not drilled into individual regional bank balance sheets to be able to say that who's at risk and who's not. But I had done a thread on this, Twitter thread on this couple of days back that till now we have not focused on the regulators' role in this whole SVB crisis. But in a sense, the SVB crisis, the genesis of it was the Fed hiking rates. And the regulator therefore knows that when you've hiked rates this much, you know the implications of it. And therefore, the regulator also had a role to play, which I think they did not
Sorry, I think we've lost her audio. Devina, can you hear us? Okay, looks like she has logged out, or we are just not good getting across. Maybe we can just take a pause and come back.
Hi, Mahalakshmi. I think I
Hi,
got
sorry.
disconnected or something. Okay, so let me just say, should I just okay
Yeah,
on this question? I think there was some laxity on part of the regulator, because this was a problem whose dimensions, at least at the macro level, should have been known. That if you raise rates in this fashion, and you know the outstanding security book in the system, that somebody has to be taking a hit. This is no
right.
rocket science. And the Fed will have information on who's holding the securities. And while it is obviously, the SVB management should have been more proactive, and I have friends who manage risk in banks, and they said they should have done all sorts of things, from swapping out the interest rate risk to borrowing against the securities. But that said, the regulator also had a role to play, which I think they did not. Chair Powell was little sidestepping the questions on this, saying that there's another unit who's looking into it as to why it happened. But he did say that yes, this risk had been identified, but while the regulators were still talking to the SVB management, the run on the bank happened. And he also mentioned that the run happened at a rate which was unprecedented and not anticipated by regulators, because I think regulators are still not living in the internet era, and there is a basic disconnect that banks um, allow withdrawals 24/7. I mean, this is like at the very end also. But the lender of last resort, I mean, there was actually that their window closed at 4 p.m. California time, and they needed a test transaction to go through before they could lend to SVB. So just on those technical things also, I mean, that the SVB collapse would likely have happened regardless. But the fact is that that lender of last resort money did not come through because of sheer technology, and the way that the Fed, in a sense, is still working the old banking hours, whereas the commercial banks themselves are working 24/7. In fact, interestingly, somebody told me that RBI has the repo window is open for 15 minutes more at midnight. So at least RBI has thought of this, that, that to be lender of last resort, you have to be available after office hours also. But the Fed, clearly, this is a new nuance for them. So that was the followed. But I mean, to me, the worrying part is this: that Janet Yellen has now said that the FDIC will not guarantee deposits beyond that 250,000 limit, and that, to my mind, might introduce instability. That's my worry, because then, therefore, again, all the regional banks depositors will start to worry, is my bank safe or not? So that is my worry, that if and SVB's problems were at least only on the investment book. Somebody else might have a problem on the credit book, so how will that be handled? And part of it is also US politics, because the Republicans don't like the Silicon Valley people, because they think they are all Democrats. So they did not like this bailout. So, it depends on which region the next problem arises. So then those are the nuances, but that's my worry, that by saying explicitly that large depositors are not protected, whether that will create instability elsewhere in the system.
Yeah, in fact, that's exactly what I was coming to. That's opposing view because Pavel said exactly the opposite, saying that depositors should feel safe, and then the market sort of reacted positively all through the trading session to only fall just towards the end after Yellen's comments. So, is that really serious? I mean,
Right.
in a situation like this, do you really see her taking such a tough stance? Because that is the genesis of all kinds of the customer behavior or large institutional clients. Their behavior is contingent on what is the assurance that the government is giving.
Right, right. Because I mean, otherwise you are unprotected. On the other hand, of course, there is, if you do bail out large depositors, you are in a sense uh, uh,
Moral hazard.
uh, moral hazard. It's kind of pushing people towards moral hazard, which is that next time depositors won't have to look at the health of their bank and just invest wherever they feel like, where because the management is a friend or because the deposit rates are higher. So that's the moral hazard. Of course, I mean, the moral hazard in this case, in the banking collapse, is one for the depositor and the other for bank managements, because
Sure,
whether it was
sure.
Credit Suisse or SVB, the bankers have got their bonuses. Even SVB's UK unit, which was sold for £1, the bankers got their bonuses, and same for Credit Suisse. So, I mean, later on, of course, after investigations, maybe some of those will have to be returned. But as of now, everybody has got their bonuses. So, moral hazard for large depositors and moral hazard for managements could be the fallout. But on the other hand, you cannot afford crisis of confidence in the banking system. And
Sure.
in banks, as I have explained earlier, also confidence is the key. Even the strongest bank in the world cannot pay back all its depositors. It does not have money sitting in the vault. So
Yeah.
you must not do anything which will shake the confidence of depositors.
Sure. So, depositor confidence and protection is one thing, Devina. The other thing I wanted to talk about is the other side, which is this emergency lending window, special bank lending window that the Fed is talking about. Does that sort of give Fed the insurance to kind of hike rates or navigate policy in whatever way it wants? Because the moment you tell the banking system that you're willing to buy their securities at par, that means at least that problem in terms of what has been created because of this sharp rise in the past 1 year, that gets resolved.
Yeah, that gets resolved, but then to an extent, it also reduces the effectiveness of your whole tightening stance, because then,
Hmm.
again, you are injecting liquidity and you're trying to prevent the consequences of your rate hike. But you have to choose the lesser of the two evils, I suppose.
Fair enough.
That is the thing. And
Fair
of
enough.
course, I mean, earlier they had said that this insurance, the higher cost of the insurance will be borne by the banks, which essentially means by the depositors eventually.
Hmm.
So, so it's not very clear what they're going to do now. Like, it's kind
Sure.
of at variance with what Yellen said.
Correct. So, going back to the US economy, I mean, again, Powell made this comment that there is a path to soft landing, and we are trying to find that. And do you believe actually there is a way to soft land?
Not completely soft. Let's see, if you look at even the Fed's estimates this time around, the GDP estimates, they have moderated. Even though both labor market, I mean, that was the interesting thing, both inflation and labor market, there isn't much change from the December numbers, but the GDP estimates have come down. But this is the Fed's numbers, their own consensus numbers. So that has been the issue, that in inflation, actually the easy part has come in already. The low hanging fruit has already come in. So goods inflation has come down, housing inflation has come down, but non-housing services inflation is proving to be sticky. So that becomes an issue for the Fed. And also labor market still remains very, very tight. So as I was saying, that Powell even said that in the from the last meeting to now, in between the numbers that came out, which was inflation and labor market, showed that we needed to tighten even more. But it's only because of the banking crisis that we have sort of gone back a bit on that track. So that those issues are not gone. And so if you still want that inflation to come back to 2%, I don't think the pain is over. So some amount of pain will still show up in the economy.
Okay. And back to this rate for a minute. If we were to take this at face value that rate hikes are behind us, do you see the Fed actually moving forward with tightening? Do you think they could do more tightening by way of contracting the balance sheet? Is that on cards at all? And should we be worried
Well,
about
right
that?
now, right now, because of the banking crisis, it has gone the other way. So
Hmm.
that the Fed balance sheet has gone up, which is what he was asked yesterday also. So that obviously now again becomes a question mark as to what needs to be done for the banking sector. Though I mean there are nuances to this, and all uh, Fed balance sheet increase is not the same. But that I think they will still the tool they are looking at is still the rate side, and especially more so because of the banking crisis. They can't really suck out more liquidity.
Fair enough. What is your own assessment? I mean, in terms of equity markets, for example, Chris Wood says that last year was contraction in PE, this year is going to be earnings downgrade. Do you think that's going to be the big thing to watch out for this year in terms of equities?
You're talking which market are you talking about?
US equities still.
Okay. So US equities actually last year was a historically bad year. I mean, it was a truly historically bad year, even on a 1 century, 2 century basis. Not just US, actually, global asset markets, I would say. So last year, if you look at the bond market in the US, it was the very worst year in 230 years, basically, since records began. And if you look at bonds and stocks both going down, it was in the last 100 years. It happened once during the Great Depression, 1931, once during the Second World War, 1941, once in 1969, and then 2022. So after 50 years, you had such a big crash in bonds and equities together. If you look at the world as a whole, every regional equity index was down. Every bond index in the world was down, whether high yield, investment grade, treasury, whatever. Only thing which was in the green last year was oil and gas and some agri commodities. Even metals did not show a increase for the year, whether precious metals or industrial metals. So after such a bad year, the it's very high probability that 2023 would be a good year, which you have also seen that in spite of whatever troubles, like for example, NASDAQ, which was kind of near the bottom in the country index list, has done reasonably well this year. So the wheel always turns. So I don't think that there's any great danger of 2023 being a disastrous year. The leadership from the last quarter of 2022 had kind of moved towards emerging markets in Europe. Because Europe is more banking heavy, they have taken a bigger hit in this whole crisis. So, many of the European countries, the indices are very banking heavy. So that has been a bigger hit. So therefore, US has actually been doing better than the rest of the world. Over the medium term, the point we are watching for is that whether leadership will move from the US to the emerging markets. Emerging markets have had a very poor stint for a very long time. I mean, the last good time emerging markets had was from 2003 to 2007. So, I mean, we're just watching. We've not made that final call yet, but that's a possibility that things will improve there. But for now, US is also not looking bad at all. So, yeah, there will be some slowdown impact. But then again, a lot of the US listed stocks are not necessarily their demand is not driven only by the domestic economy. They are fairly global companies, many of them. In fact, most of the larger ones.
Correct. In fact, that's what I want to understand. That if U.S. equities earnings story is not looking good, but you're saying that market perspective is not looking bad at all. What does it mean, both in terms of implications for emerging markets and India? Is can they really go separate ways?
Well, they go separate ways in terms of, see, first of all, the economy and the stock market can go separate ways. Look at
Right.
China. The high was in 2007. Last year, they were at half the 2007 levels. The economy had gone up 6, 7 times. So it can be that kind of disconnect. So, and India, if you're talking India, India is not very export oriented in terms of its composition, so, except for the IT services, which obviously have which are, that's the big sector which has exposure to the globe in a sense. Other than that, I don't see such a big exposure. So some amount of, and if you look at Europe also, Europe, for example, we missed that move. That last October, when we were sitting, we saw Europe and we said like all the news in Europe is going to be negative in terms of fundamentals. So abhi to nahi chalega. But that ultimately that market moved, and that was the best market from October till about February or so. So that is why there can be a disconnect, that just because more bad news is coming, the call is whether it is in the price or it's not in the price. As I said, for the fundamental impact on economies, the more export oriented economies in the emerging basket will probably be little more impacted if there is a prolonged slowdown in the West.
Sure. And within the emerging markets pack, how do you see India? Largely it's been a great performer, but now you see with rest of the markets, Korea, Taiwan, and of course China, you've got some mixed signals. But all of those have been going up, and India started off this year on back foot. Do you see that equation changing? We should still be able to be one up on other emerging markets this year too.
So in 21 and 22, India was an outperformer after a very long period of underperformance relative to its history and relative to the globe both.
Yeah.
So I don't think that trend is really broken in the medium term. We got a bit derailed because of this whole Adani saga, which also then affected the banks. As of now, of course, the best emerging markets that we like are Mexico, Taiwan, and a couple of others. India is not quite there yet because we think there will be some probably treading of the water or sideways or volatility for just another couple of months maybe. But I mean that's always difficult to predict. So, but we don't think the good trend is broken yet either on outperformance, and the risk of a crash is very minimal compared to the risk of missing out on a up move where we stand today in India. I just before this I was talking to somebody who wanted to invest, and I said, time I think is of the essence, because you never know. I mean, you in June last year I said the same thing, and later on I saw the index was 15,300. Then there was an 18% move in 2 months. Did I know there will be an 18% move in 2 months? No, but then again there was this risk that you will miss out on certain good days, and I think we are pretty much there, because see, sentiment is a contraindicator. When
Hmm.
everybody is scared, thinking abhi sochte hain, things are looking uncertain, and this is all academic studies show that when people are downbeat, the next period returns are above average. When people are very gung ho, the next period returns are below average. So every academic study in every country in the world has shown that. So I think in India, probably we are being little more pessimistic than we need to be, and it is time to be in the market.
Sure. And how do you position yourself in this market? I know a few months back you were still very bullish on financials. Does that still hold good?
No, actually, a few months ago, the number one sector which I have been speaking about was capital goods and industrial machinery. So that we have liked for a year and a half. It has given us great returns. We have booked some of the profits. We would still be significantly overweight there, though a large part of the move there is done because it's done very well. Many stocks have doubled and tripled. So the financials, as I said, was a change for me. It was not that, we went hugely overweight financials, but we went to market weight in financials middle of last year.
Hmm.
And we would be a bit overweight financial, not financials, actually banks only. We don't hold
Hmm.
non-bank financials. So in banks we went to market weight, where we would be somewhat overweight now because of price moves. What we added in our last rebalances was a bit back on the IT services. We put it back. We added some pharma, some auto components. um, we still hold some textiles and chemicals, but those are bottom up picks rather than sectoral calls. So that would be broadly the pattern of what we like.
So in terms of sectors, capital goods continues to be on top for you right now.
Yes, still that still continues to be on top.
Okay.
So as I
And
said, we booked some profits, but still in terms of the relative our overweight, that would still be number one.
okay, one last question on tech companies, on one tech services companies, and second the new age tech like Zomato, Paytm, PB FinTech. What's your take? Because most of those companies are now, you know, sort of. I'm not sure whether they're still walking the talk, at least talking about the path to profitability, and prices have come off, of course. So both
Yeah,
IT
frankly,
services
we have
and these companies.
yeah, frankly, we have not looked very closely at the new age tech companies, because it's, still, if you look at relative to any global benchmark, they are still very richly priced.
Hmm.
And companies where there has been a long history of having been listed, I mean, at least longer, like Uber or DoorDash, etc., even on a multi-year basis, they have not been great performers. So I mean, I'm not saying that at certain price you will buy, you will not make money. But we are not really in that business, because our focus, as we always say, is on risk management. That investing is a loser's game. So first, make sure you don't lose big.
Right.
So anything, just because it has fallen X% doesn't mean that it can't fall more, unless we really see fundamental reasons why it should not fall more. So we have not started nibbling there. As I said, we are a risk averse portfolio manager, and that's the way we like to do things, because the alpha comes, there are enough outperformers in the market without having to take extra risk.
Fair enough. And software services.
Software services, as I said, in our January rebalance, we added back a bit. So we were somewhat underweight. We are somewhat overweight there. I think more mid cap IT, but we do have some of the large caps also. Because I fundamentally it's a industry that I like, with some amount of dollar hedge, some amount of predictability. Of course, that may be hit by this banking crisis, because banking is a big buyer. But then again, there's always opportunity also. If two banks merge, there is a lot of IT services stuff to be done.
Right. Sure, that's all, Devina. Such a pleasure talking to you. Thank you so much.
Thanks, Mahalakshmi. Great speaking with you.